Well guys, as I'm sure you guys are aware, 2023 is shaping up to be an even crazier year than 2022. But let's take a look at the Fed specifically, because all signs point to them being completely hawkish through all of 2023, maybe even into 2024. And shockingly, I ran across a video on CNBC that I actually might agree with a little bit. Now, I know that's shocking, it doesn't happen often, but guys, there really are some good points made in this video, and obviously I'll give you my take on it as well, because well, the one thing they did miss, which of course they missed something, was kind of the hidden messaging behind all this from the Fed, so I'll make sure I give that to you guys too, so that way you understand exactly what's going on. I know Christmas is over, but if you would please just hit that like button and subscribe to the channel. I would really appreciate the late Christmas gift or the early New Year's gift. I mean, you guys can see I got one of my Christmas gifts right here on, and I'm here with you guys from a secret mountain location nobody could ever find to bring this content to you and to make some content for my group specifically, and to do a bunch of other things like that, goal setting and planning and all that sort of stuff like that we like to do here at the end of the year. And if you need help with your plan or valuations, or you want to take a bunch of courses on stocks and money and all that sort of stuff, real estate, make sure you check out the link down below, as the holiday sale is still going on. But I know that's not why you're here, guys. Everybody's probably broke from the holiday season. I completely understand. So let's jump into the video right here.
That is getting its way all over the place. If you were to substitute more recent shelter data, specifically rents, for the extraordinarily lagged data that is going into the Fed's calculations, they are very much going to continue to get their way in January, February, and March.
He makes a great point right there. The rent data specifically lags so bad with the way the Fed calculates it. It's not even close. And everything that I'm hearing and that I'm seeing, obviously being involved in real estate and some commercial real estate, got some friends involved in a lot of commercial real estate, they are actually seeing the rents come down as well. Just kind of something to keep in mind as we kind of go through this. So anyways, back to it.
Looking at the next CPI report, most likely with a 6 handle, and that is most likely going to continue to fall from there. The question is, how fast will it continue to fall? And I know that sounds crazy. We've been like, oh, it's so stubbornly high, forget about it. You just got U.S. retail sales in November down 0.6. That was supposed to be down 0.1. The consumer has gotten the message. They have stopped spending in a lot of categories on a dime. The housing market is frozen. There is nothing going on there. Don't tell me that the Fed isn't making progress on inflation. After talking to mortgage people, realtors, forget it. It's over. And housing has a huge multiplier effect. It could be as high as 18% of the economy.
So there you are right there. As you can see what he's talking about in terms of real estate slowing. I wish he would have said more. Obviously consumer spending being down 0.6 versus the expected 0.1 coming off the record November we had last year isn't the worst thing in the world. It doesn't necessarily mean the Fed is completely getting its way. But you would agree, anybody who talks to any sort of real estate professional and such, housing as completely, not necessarily ground to a halt, but the industry as a whole is significantly slowing down. Sales are significantly slowing down. Now, again, this is coming off of 2 record years prior where your home prices were basically going up like 20% or something utterly ridiculous like that. So when you're coming off records, of course you expect a slowdown. But the slowdown has been a lot harsher than I think a lot of people thought it was going to be, even though the Fed said, hey, the pain, and they were talking very specifically to the real estate market. Jerome Powell called out real estate specifically and said, there's going to be a lot of pain there. Not a little bit, a lot of pain in the real estate market. So you need to be prepared for that. And he kind of said that coming in. So it's not like this is surprising or anything else to the Fed. So you got to kind of keep that in mind as you're kind of thinking about what's the Fed thinking? Are they seeing all this devastation? Are they ignoring it? No, they know it's coming. They know that it's probably there. But remember, they told you it was coming, which means it was part of their plan. So, you just got to kind of, keep that top of mind and understand where Powell is coming from when he says stuff like that. And kind of when people freak out like this a little bit or say very dramatic things and such, that they're not really reading into what's actually going on with Powell there. And the fact that, yeah, they already know it and they expected it in the first place.
On the inflation data Tuesday, CPI, medical costs are falling, airline ticket prices are falling.
My airline ticket prices didn't fall. Yeah, my airline prices did. My airline tickets didn't fall during this Christmas season. I don't know. Maybe he's got different people than me. Maybe overall they have. Honestly, I go back and look again. I don't remember what it was. From the November report. I have to go back and look, but definitely my tickets didn't fall. At least not that much.
Electricity costs have fallen. So the Fed is getting their way, but they have to keep talking this way, regardless of what the 10-year is doing, which is laughing in their faces. They have to keep talking this way because the worst risk is that we take a pause, and then because people let down their guard, financial conditions start to ease a little bit, and then all of a sudden they have to come back with another 50, another 75.
Right?
We don't want that.
They already have.
We don't want
Since
that.
the last hike, the financial conditions have been easing, right? And that's been one of the issues. Everything that you said, Josh, of course, is correct in terms of...
Yep, they don't want to play the yo-yo game. They want to kill inflation and kill it forever. As we saw in the 80s, the last time we had this, you had inflation ramp way up, then it had a huge drop down, whenever they basically just jacked the rates up to 20% or so, and then they let off the gas and they started easing rates back down, and immediately inflation shot right back up. So they want to make sure, that's the reason why I think when they raise, they're going to keep that sucker raised for a long time, 6 months, 8 months, a year, before they actually start, lowering that rate, basically getting back to whatever they determine is kind of the natural rate of where they want that rate to lie in the end, for the long term. So
the direction of inflation, yet they're not satisfied. Why? Because they're willing, it sounds like, and it certainly seems like, they're willing to have a recession. They essentially want to put the economy in a chokehold and hope that it taps out without being carried out on a stretcher. That's what Powell's hope is. Why? Because...
yeah, that's essentially, even though they won't outright say that, their actions from the start have done exactly that. They are doing things to invert the yield curves, if I could talk. They're doing things to invert those yield curves and to create a recessionary environment. Now, of course, they don't want to create a bad recession. That's what the definition of a soft landing is. Obviously, a soft landing would be no recession. But at the same point, if we can have a mild recession, which technically we had one earlier this year, obviously I think it'll be a little harsher than that. But if it's still mild in general, then actually the Fed kind of accomplished its goal, and that's still what they're kind of hoping for. But you can't have that. You can't stamp out inflation without having some sort of a small, minor recession at least happen.
He needs the economy to tap out.
He could say whatever he wants. He could say whatever he wants. He cannot continue to raise with the 2-year, 5-year, and 10-year falling at the pace they are. The dollar has peaked. Rates have peaked. The Fed can say whatever they want, and arguably they should continue to deliver this message. But the concern in the market, and rightfully so, is now shifting toward recession and away from inflation. And everybody knows it. And all of the data is screaming that message. And I'm going to tell you, a lot of the economy already is in recession, in addition to what I just talked about with housing. And I think the rolling recession call, which I think is Citigroup, is going to be the right one because we're already living through it. It's not a prediction. It's actually happening. A rolling recession is interesting. It's not as coordinated.
Exactly. Yeah, that's exactly what I think is happening too right now, or what we may actually see during this environment, because there's too many things that are fundamentally strong and then other things that are structurally weak as well going on at the same exact time. And of course, it's going to kind of hit different sectors differently at different times. And of course, as rates go up, that hurts some. It may actually alleviate some other issues in some other areas and such. And so that kind of creates basically like a rolling recession where different areas of the economy get hit at different times, which of course was not the case back in like 2008, where just everything cratered. Everything was bad all the way around the block. There was no getting around it. Everything was just in the toilet and such. And right now you do see scenarios, and it's actually playing out like I'm sure he's going to explain here. We'll see what he says. But anyways, it's playing out to where that's exactly what could possibly happen, is we basically have, a recession in one area, and then as it kind of works its way through, it kind of moves to another area as that area strengthens, and it kind of goes through all the various different sectors of the economy as we kind of move forward. So
as you would like it to be, like in COVID, where we actually could pinpoint the start of the recession to a specific day in March.
COVID.
This is trickier, but a rolling recession is what is currently occurring. It's undeniable in certain sectors, and if it hasn't gotten to your sector, give it a beat. And in that environment, I have to believe that the Fed is going to look around and say, okay, our job's not done, higher for longer, et cetera, et cetera. But it's going to be more bark than bite from this point forward.
I mean, that's not necessarily, Jason, what Wall Street sees. Goldman sees 3 more hikes coming. 3 additional 25 basis point rate hikes, February, March, and May. Deutsche Bank, 17 hawks, 2 turtle doves, and a 5.1 terminal rate is the headline for them. they've got a forecast of 5.1.
I guess they started drinking ahead of time. I don't know. I agree with the 3 more rate hikes there, 2 to 3. I think the Fed is just going to be conservative to make sure nothing gets out of control. They screwed up so much before, and since they screwed everything up, have done a fairly decent job of being consistent, putting out a consistent message, consistently raising despite this showing this and that showing that, basically sticking to the plan and messaging it properly. So I don't see any reason why they would all of a sudden just not raise it all next year. I just don't see that happening. I think 2 to 3 is about the right range, and see how everything falls in the meantime, and then kind of accommodate from there what's going to happen. But they said they want to get to 5.1. I see no reason why they're not going to get to 5.1. So I guess they could get there in all one fell swoop if they wanted to, but it's probably going to be broken out into 2 or 3 raises to get themselves there. So let's kind of see what the rest of this says here. 17 Hawks, 2 total. I don't know, man. I guess they started drinking early holiday time. Who knows?
I mean, by May. So they see many more hikes as well.
Right.
I mean, the Fed chair, Jason, keeps telling you what's coming. Some don't believe it, but he's living up to the hype thus far.
Yep. There's no doubt about it, Scott. And obviously, the Fed has already moved 425 basis points this year, right? The terminal rate, to your point, is above 5% now. What I heard from the commentary in the presser the other day is he's obviously focused on labor. The labor participation rate has not moved at all. There is a structural issue with labor on the supply side, and that will continue to press and move wage inflation, right, which could be a precursor to more inflation. So clearly they're still focused on raising and hiking into the new year, but they've done a lot already. And to Josh's point, you see it, it's working. With the retail numbers we saw this morning, manufacturing negative, Philly Fed was a miss. So the work they're doing is missing, and there's a lag effect in labor. So let's see what happens going into next year. But to Josh's point as well, I think they have to continue to bark and talk the way that they're talking, but they might shift gears, going into Q2 and to Q3 of next year.
Yeah, they're not going to do that, though, until they get past all the rate hikes and everything else, guys. So that's just, they've got to get to where they want to get and then kind of let it all play out from there. And in regards to the labor market there, they're saying they actively need unemployment to get higher. So keep that in mind as well. Remember, the natural, a good unemployment rate, kind of where you want it to be, is in the 4s, the 4 to 4.5 or so. And right now we're sitting at 3.7. Obviously, we all know that's going to go up. The question is, can they get it back up into the 4s, which is a healthy labor market? And then if they start to creep up into the 5s, did they let off the gas earlier on, by the time the data, of course, the data lags, for them to, basically be able to kind of just stay in that 5 and then naturally drift down as we kind of come through the recession and kind of come out the other side there. That's the balancing act they're trying to play right now. But for right now, the labor market is still ridiculously strong, which I think is what they were speaking to. Like, hey, just something seems to be broken there off. It kind of needs to correct itself. So we got to wait and see when that thing gets up in the 4. Like I said, we may even hit the 5s before we kind of start finally seeing that kind of level off and come back down. But the Fed has actively said that's exactly what they want to have happen, and that's exactly what they want to do. So hopefully you guys enjoyed the video here from Colorado. I apologize. We'll be back to my normal setup as usual. And, basically click this video here if you want to see what stocks I'm buying during this downturn, and click here to see exactly what I'm doing during this downturn. So thanks for watching, and we'll see you in the next one.